Hi everyone and welcome back. In the last year, we've kind of seen the economy and the stock market move in opposite directions. While Nifty and Sensex, the major indices we look at, are reaching record highs, at the same time the economy of India contracted by 7% in the last year and is starting to rebound now. So what's happening here? Are the economy and the stock market even correlated to one another? I think one important factor here is that for a lot of us, indices like Sensex and Nifty are our gateway into financial and economic information, and it's one of the first things we encounter. So maybe we do expect them on some level to move in tandem. So to what degree are the stock market and the economy connected, if at all? Let's find out. The first thing to consider here is that India actually has two parallel economies, the formal economy and the informal economy. The formal economy is pretty simple to categorize. It contains formally registered companies such as public companies, corporates, and all of their employees, and could even include some individual contractors. Small businesses such as those of traders which aren't incorporated, vegetable vendors, artisans, daily wage laborers, all of this becomes a part of the informal economy. These figures are tough to estimate, especially since the pandemic, but the most recent data from 2019-20 shows that about 80% of the workforce in India are employed by the informal sector. Further, this informal economy also produces about 50% of India's GDP. What this tells us is that the stock market, as important as it may be, doesn't represent the vast majority of people, their professions, and even the economic output that they generate. The stock market looks at the formal economy, and that too the largest and most organized segment of this formal economy. When you look at the Sensex 30, for example, you're looking at 30 of the most valuable and highly traded companies on the Bombay Stock Exchange, which itself has a very high bar for the companies that are listed on it. The makeup of India's economy is skewed towards small and medium enterprises, small manufacturing, and even agriculture, all of which are not captured in any way by the stock market. The next point here is that the market and the economy work on different underlying principles, have different priorities, so what might be good for the stock market is not necessarily good for the economy. The first thing most investors look at when they're looking to invest in a company are earnings and profitability related to revenue, of course. So stock markets are linked to profits and profitability first. Let's have a look at some of this data from CMIE, which is the Center for Monitoring the Indian Economy. They compare corporate profits as a percentage of GDP over time to see how this share has changed. As you can see, this ratio kind of peaked in 2007-8 and had been declining ever since until the pandemic when it started to shoot up. This seems like a good thing, right? Corporate profits become a larger percentage of the GDP and form a larger part of the economy. However, when you have a closer look at this data, you can see that this higher profitability has been achieved by cutting down costs. A recent report called the SBI EcoRap talks about how for corporate India in the last year, profitability has increased and so has net income, but this has been done on the back of expenditure cuts, such as an average 3% salary cut across all these companies. This report also said that expenditure cuts have contributed about 31% on average to the top line of these corporates as companies find different ways to navigate through the pandemic. However, let's have a look at what this process of cost cutting involves, right? When corporates cut down their expenditures, they are renegotiating contracts with suppliers, maybe cutting down on some purchases, reducing the salary of these employees. All of these things in turn go on to reduce consumption, which then affects the GDP negatively because less goods and services are being produced and consumed. So as we can see in this case, what's good for corporates, profitability, and therefore the stock market and its investors isn't necessarily good for the larger economy of India. Now we come to one of the most significant points, which is that markets tend to be forward-looking, while economies and economic data especially are all based on past results and observations. As we know, sentiment and psychology can play an important part in markets, and stock markets don't just cover the present value that investors see in a particular stock, but also its future potential. We've all seen the way in which news or policy announcements about the future can cause differences in the price of a stock, as the future possibilities and value also tend to affect the price today. It could even be said that the job of financial markets is to establish a consensus view of what investors think about the present and future possibilities of these publicly traded companies. In contrast to this, you can see that most economic data, especially macroeconomic data such as inflation, growth, employment, all of it is based on past observation. Even when projections are made for these numbers going into the future, they tend to be based on the observations and patterns that we have seen in the past and the data that we receive. A lot of studies have actually run correlations between stock market levels and GDP growth and found them to have a low or no correlation at all over the long term. However, this does not mean that they are completely disconnected. It's just that they don't tend to move in tandem as closely as some people might think. As I've spoken about in a previous video, the RBI has come out and said that we may be in a bubble when it comes to the Indian stock market. If you'd like to know more about this topic in detail, I'll leave a link to that video up here. But the short of it is that there is a sense that Indian equity markets are a bit overvalued right now. The PE ratio we're seeing from these indices today is actually higher than the level it was in 2000, just before the burst of the dot-com bubble, or even in 2007, just before the financial crisis hit. Further, seeing the good performance of these markets in the last year, stock market participation has also drastically increased in the last 12 to 18 months. Alright everyone, I hope that this video shed some light on the relationship between the economy and the stock market. The stock market represents the most organized and corporatized parts of the formal economy and therefore can sometimes seem disconnected from the rest of the economy as a whole. If you enjoyed the content, please do like the video and subscribe to the channel as it really does help me out. Thank you and I hope to see you again soon.